Hello, this is Domenico with Easynomics, and we're going to look at a solution for a negative externality of consumption. We applied the example of cigarettes as a demerit good consumed by the household to which society would like less consumption. And in that previous video, we talked about how cigarette consumption is linked to lung cancer. And for those that develop lung cancer as a result of their consumption of cigarettes, if they use public health services, it is society, the taxpayer, that is paying for that treatment, and that generates an opportunity cost. Those funds could have been used for something else. So we're looking here at taxes, cigarette taxes in the United States. In this playlist, I will have another video that discusses this in a little bit more detail. That video is looking at the tax burden and how the consumer with the more inelastic demand curve will carry the burden. So I'm not going to go into too much detail about this because it's covered in that video. In terms of a recent example, in 2009, under the Obama administration, federal tax rates on cigarettes were increased from just about 40 cents per pack to just over $1 per pack. And here we see that Nobel Prize-winning economist Gary Becker calculated that the increase in the price of cigarettes would be about 13.3%, which would lead to a 10% decrease in unit sales. Thus, we can see that the percent change in price is greater than the percent decrease in quantity demanded, highlighting that the demand curve is inelastic because of the addictiveness of this good. In that video where I talk about the consumer carrying the burden, we can also use that as kind of an evaluation of taxes on demerit goods, and if they're inelastic, how they have the capability of being a regressive tax and kind of being punitive towards lower income consumers. But that's in that video, so I'm not going to dwell on that. We can take a look here, though, at how cigarettes are charged by state. State of Alabama, 67 cents per pack. Alaska, $2 per pack. 37 cents per pack in Georgia. And you can see here that this creates opportunities for smuggling. Smugglers in Georgia can buy cigarettes that are priced lower or taxed lower and then smuggle them into another state and sell them below the price of that state in a type of parallel or black market. So that can also be kind of an evaluative point made of a limitation of taxes on negative consumption. So let's go ahead and illustrate this. So we're looking at cigarettes as an example of a demerit good. Other demerit goods can include alcohol, gambling, and in this case, drugs, and in this case, we're looking at cigarettes. So here we have our price on the y-axis, the quantity, supply, and demanded for cigarettes on the x-axis. We're looking at the free market, and we have our supply curve that's upward sloping according to law of supply, labeled S1 equal to MPC. And because this is negative consumption, we're going to assume that in the production of cigarettes that there is no negative externality, no negative spillover onto society. So we're going to state that MPC is equal to MSC. The intersection, and then we have our downward sloping demand curve labeled D1 equal to our marginal private benefit. And we can also see that the price elasticity of supply is greater than 1. All right? It's more elastic than our demand curve, highlighting that it is a manufactured good. And because it's a manufactured good, firms that produce cigarettes have the ability to store stock. They may have spare capacity. They may be able to quickly mobilize factors of production. Okay, meaning that they're able to easily employ resources, land, labor, capital. So these characteristics of the manufacturing and production of cigarettes provides a elastic supply curve. In terms of demand, because of the addictive quality of cigarettes, the PED is less than 1. All right? Consumers will continue to consume even if the price rises because of its addictive quality. All right? So the addictive quality of cigarettes causes it to have a very inelastic demand curve. So we can see where S1 equals D1, it provides the free market price at PM and the free market quantity supply and demanded at QM. All right, but society would like less consumption of cigarettes. They see that cigarettes are correlated with lung cancer, and for those people who develop lung cancer through their consumption of cigarettes, they may seek treatment and help through public health services, so it is the taxpayer, thus society, paying for that treatment. And society would like that tax revenue to be spent perhaps on other things, since this is a preventable disease. So the social benefit curve would be below that of the private benefit curve. Okay, so let's go ahead and illustrate that in parallel to the MPB. All right, so let's just imagine that society would prefer this level of consumption. So this is D2, which is equal to the marginal social benefit. Okay, perhaps I can clean that up just a bit. There we are. So let's mark this point B so that we can highlight that at the free market quantity of QM, we can see that the marginal social cost is greater than the marginal social benefit of the consumption of those cigarettes, which we see right here. So point A is the marginal social cost, which is greater than the marginal social benefit. Thus, there is an over allocation of resources to the production and consumption of this good. Society would like less. So social optimum is achieved where marginal social benefit equals marginal social cost. That would create an allocatively efficient outcome, which is right here at point C. That would provide the optimal price at P opt and the optimal quantity at Q opt. So that is our illustration of negative consumption. We've already done this in the previous video, and we highlighted that this triangular area, let's use another color, is the welfare loss. Okay, there we are. So how can we solve this? We can apply let's say, a per unit tax on each pack of cigarettes. Okay. So this is a market-based policy, right? So the solution number 1. This is a market-based policy. Of applying an indirect tax. And it's a tax, in this case, per unit of output. Right? It's a tax on each unit of output. All right? So for each pack of cigarettes produced, there is a tax on it. Now, you know that taxes have the effect of increasing the cost of production, thus decreasing the supply curve. All right? To illustrate this, I'm going to have it reach this point. I'm going to make a little note here to achieve that point here. And the supply curve will go to that area. All right, so it's going to come right to this point. Supply shifts in to S2. And S2 equals the marginal private cost plus the tax. Okay? The distance between S1 and S2 is the size of that tax. So what does that do? That has the effect of increasing the price paid by the consumer. So price rises from PM to PC, price paid by consumer. And we can see that the price paid by the consumer minus the tax provides the price that's received by the producer. So I'll label that price received by producer equal to the optimal price and the higher price paid by the consumer. So we can see the tax revenue that's generated that will be allocated towards the government. Right? And I can highlight that boxed area. Let's say we'll use this color to highlight the tax revenue that will be given to the government, which will assist the government in paying for the public health costs for those that need treatment from lung cancer. Okay. Now, one of the negative effects of this tax is that it severely increases the tax paid by consumers versus the tax burden carried by the producers. So we can divide this tax revenue into two areas, highlighting that the consumer burden of the tax is this area here, from the equilibrium, the free market equilibrium price, up to the new price paid with the tax. That is the consumer burden, and the producer burden is this area here. So we can clearly see that the producer burden of the tax is much less than that of the consumer. And that's a result of the inelasticity of the demand curve. Again, since PED for cigarettes is less than 1, we know that the percent change in price is going to be greater than the percent decrease in the quantity demanded. So consumers will continue to consume even as that price rises. We see that distance between PM and PC much greater than the fall from QM to Q opt. Okay, so here we have effectively drawn a tax on top of a negative consumption model. So let's go ahead and analyze this as we would for a paper exam. As can be seen, we have a graph A, illustrating the market for cigarettes. We're measuring the price of cigarettes on the y-axis and the quantity of cigarettes on the x-axis. We have two downward sloping demand curves labeled D1, which is equal to our marginal private benefit, and D2, which is equal to our marginal social benefit. And we have two upward sloping supply curves, S1 equal to the marginal private costs of producing cigarettes, which is equal to the marginal social cost, because we're assuming that in the production of cigarettes, there's no negative spillover towards society. S2 is equal to the marginal private cost plus the applied tax. Since cigarettes are a demerit good and society would like less, the government will intervene to apply that tax. But before, let's talk about the free market equilibrium. So where S1 equals D1, or where marginal private cost equals marginal private benefit, it provides the free market equilibrium price at PM and the free market equilibrium quantity at QM. But we notice that at QM, or at point A, right, at QM, we see that the marginal social cost of the consumption of cigarettes is greater than the marginal social benefit. Right? That generates a welfare loss, which is the shaded blue area here, the shaded blue triangular area here. Thus, there's an overallocation of resources towards the production and consumption of cigarettes, so society would like less. Social optimal would be achieved where marginal social cost equals marginal social benefit. Society would like less demand, less consumption. That would allocative efficiency would be achieved at point C, and that would provide the optimal price at P opt and the optimal quantity at Q opt. In order to reduce consumption of cigarettes, the government intervenes through the use of an indirect tax, or a tax per unit of output. Each cigarette pack that's produced, there's an applied tax. That has the effect of shifting the supply curve in from S1 to S2, which again is equal to MPC plus the tax. That creates a new equilibrium, all right, at point D, providing the higher price paid by the consumer, labeled PC, and then PC minus the tax provides the price received by the producer, which is labeled PP, which is equal to the optimal price. Because of that increase in price, we see that there is a decrease in the quantity of demand along the demand curve from point A to point D. And as a result of the lower price received by the producer, we see a decrease in the quantity supplied along the supply curve from point A to point C, or quantity supply and demanded falling from QM to QOpt. Now keep in mind that with the tax, there is no welfare loss that is generated, because at point D, we've reached the social optimum level of output. One important point, though, is that because the demand curve is inelastic or less than 1, where the percent change in price is greater than the percent change in quantity demanded, it is the consumer that carries the burden of the tax, right? Which we see in this blue rectangular area, versus the producer's tax burden, which we see in this kind of brownish orange area. Okay, and that's it. So in the information section of this video, I'll provide an outline for this analysis. And that's it. So don't forget to subscribe and to like. And if you have any questions, feel free to comment. Thank you so much.